about how it will affect, more particularly, fixed income investments for this session. Okay, we will be joined by Mr. Rico Gomez. Rico is the Chief Investment Officer of BPI Investment Management, Inc., in charge of managing the largest mutual funds in the country with over 225 billion in assets under management. A veteran fund manager with over 25 years of investment and trading experience, having been the head of investments for various financial institutions. Welcome, Rico.
Good afternoon.
And then next, we will have Mike Enriquez together in this panel. He is the President and Chief Investment Officer of Sun Life Investment Management and Trust Corporation. He is also another veteran fund manager with over 25 years, or with about 25 years of investment experience. He is in charge of managing the investments of Sun Life insurance funds as well as mutual funds. And Sun Life Mutual Funds has now more than 180 billion in assets under management. Welcome to the panel, Mike.
Hello.
Hi. Hello. Gentlemen, dinig nyo naman ng report ni Dr. Habito. Mukhang medyo... Let me go straight to the point. Mike, unahin kita. Let's go straight to the point. Given the presentation of Dr. Habito, how would you manage funds now in this kind of scenario? What instruments can our retail investors consider with what? Interest rates so high, inflation high, exchange rate competitive. Where can we go?
Yeah, I think it's really a tough question right now. And for us fund managers, it's really hard to navigate the markets. But clearly, mukhang kailangan natin to risk off. I think although we've seen the equity market really correct, I think down over 13% this year. But I think there might be some room to further go down because of sentiment. As what I think Dr. Habito has pointed out, a lot of industries that can benefit, in fact. But it will take time. I think, as you mentioned, it will take a lot of time. And I think what I'm hearing consistently is the government needs to deal first with higher inflation and to plug the budget deficit, add more taxes, or borrow money. So what that means is interest rates will start to be elevated. On the shorter end, I think interest rates will start moving higher as I think the BSP might have to be a bit more aggressive in raising their policy rates. On the longer end, as the government has been issuing more bonds, in fact, over the last 2 years, we've in fact doubled their debt stock, I think. So really a lot of pressure in interest rates. So for bond investors, I think it's really time now to look at investing in the more short-dated instruments. For example, a money market fund that we run, or some of the fund managers run. I think that's one way for you to preserve a little bit of your dry power, so to speak. By rather than investing in cash, I think a money market fund can give you better yield. At the same time, a lot of flexibility to transfer into riskier assets when the time comes. So for us fund managers, we the way we shield investors who are currently invested is we've in fact reduced the length of bonds that we invest in, because the shorter the bonds, the less likelihood it will react to higher interest rates. But definitely it will be affected, but at least mas konti yung mas shielded ng konti yung investors.
So risk off muna, Mike, risk off muna.
Risk off pa rin eh. But of course, admittedly, marami na tayong nakikitang cheap higher rates. I don't think we've seen this level of interest rates over the last 3-4 years or even 5 years. We've been so used, especially the new investors. I think over the last 10 years, they've been used to low interest rates in high equity markets. Right now, it's the reverse. I think there's a lot of opportunity when the time comes for bond investors to start taking advantage of higher rates and locking in higher rates. Because I don't think it will move up higher, but it will not go up continuously high. So there will be adjustment and opportunities for you to lock in rates through bond funds.
Asa na ba ngayon? Ang 10-year mo nasa 7% na.
Nasa 7%. We started the year at under 5%.
So, yung 8% na inflation ni Joey, nasa natin titingnan ng 10 years ngayon?
Well, we're still below the real yield is still negative, diba? So there might be some pressure for rates to still move higher if inflation is still projected to stay elevated. But hopefully we can see it peaking sometime next year or early part of next year.
Parang na-anticipate na nga di ba? Parang ang bilis na ginalaw ng 10 years I don't know to what extent has already been in the price.
Yeah, kasi I think for inflation, it's really on the shorter end of the curve that reacts. The longer end of the curve is really more reacting to the higher debt supply, higher risks of government. But on inflation, it's really the shorter end. That's why the policy rate, the overnight rate of the BSP is the one that has to be adjusted first for it to hopefully normalize.
So maganda, you get mo na money market dito sa short end. Tapos yung long end, kuha ka ng mga magagandang yield.
Yes, I think because us for fund managers, we've been adjusting already the bond funds because we know that if rates move higher, tatamaan talaga yung mark to market. So right now, as we get more funds, we are able to reinvest it in higher yielding instruments. So the yield of it continues to move higher, at least the accrual portion.
Sige, for my second question to you, BSP, sabi nila, parang behind the curve yata si central bank. Pero although Dr. Habito say, mukhang that's the right thing to do. But what is your comment on that? Are they behind the curve? Do you believe they have to be more aggressive? Anong tingin mo dyan?
Kasi for the central bank, the BSP needs to have a balancing act of curtailing inflation, saving the peso, or tipping the economy to a recession. If you overdo it, diba? So that's why the important thing to remember is in case inflation really goes out of hand, the BSP has the right tools to be able to combat it. We're coming from a low base. I think one thing that they still haven't touched are the GIRs. They can always sell the $109 billion of reserves just to combat the peso. But for them, no, I think the important thing is we need to cuddle this economy coming from the COVID-19 and then try to manage inflation at the same time without tipping it to a recession. So I think I agree with Dr. Habito. I think the BSP is doing being more dovish than hawkish in terms of their handling of the situation.
So talagang balancing act, talagang medyo...
Okay, medyo mahirap yung trabaho nila ngayon Kasi sa US, di ba, they're being accused. But the Fed has been very hawkish. That's why the fear now is not inflation, it's recession in the US.
Talaga? But ano yun? Bago kita pakawalan kasi I want to understand that also. Itong talaga are they pushing it to recession? Mukhang dun papunta yon para naman tumigil yung di ba, yung inflation? Is that
sabi naman ni Chairman Powell, they don't think the aggressiveness of their rate adjustments won't tip the economy to recession according to them based on their models. But of course, the market always anticipates if the shorter end of the interest rates are higher than the longer end. Usually it's a good indicator of a recession is coming early next year. But we'll see.
Sila rin, mahirap ang trabaho nila.
Yes.
Yeah,
Mahirap
yeah.
na
Sige,
yun,
sige.
mahirap na yun.
Yeah, sige, balik naman, punta naman ako kay Rico. Rico,
Yes, sir.
I'll ask you also, how should investors position now for the rest of 2022? Should investor buy direct bonds? Ito, yung mga 6 to 7% na yan, or just and hold it to maturity rather than invest in like bond funds. Sabi ni Mike kanina, tinatamaan yung mark to market. Anong maganda dyan?
Well, buying direct bonds, of course, vis-a-vis the investor survey that you made, everybody really wants just steady yield. So buying direct bonds will give you steady yield. Unfortunately, you have to consider the sacrifices you make when you buy direct bonds. One is you lock yourself up immediately. You will be locking yourself up for 5 years. If you want the 6%, you want lock yourself up in 5 years in a rising interest rate environment. You'll also lock your tenor in the sense 5 years, you lock in the rate. And especially, you lock in your liquidity, which for some people, a bite size of a bond will be still quite chunky. So the way I see it is, I like bond funds right now, especially. I'd just like to highlight this for some. There's some advantage for some mutual funds like us, where you have accrual-based portfolios, where a good chunk of our portfolio is accrual-based, meaning we are not subject to mark-to-market, and you will, whatever the bond you buy yields, that is what you will be returning on a daily basis.
Ano ibig sabihin nun? Accrual-based. Are you talking about the ALFM bond fund? Is that the one?
Yep. I'm talking about our ALFM bond fund, where we also have mark-to-market portfolios, but a good chunk of the way we've reacted to this market, as you said, our reaction to this market is we increased our accrual portfolio to manage the volatility of the market. The market, because rates have gone up significantly, the mark-to-markets are getting hit. Accrual portfolios basically just say you buy it at 6%, you will make 6%.
Okay. And the ALFM bond fund is managed that way, more or less.
Yes, the ALFM bond fund right now is currently only about, we brought it down, we've only about 18% already in mark-to-market portfolio.
Meaning the balance is more or less
accrual,
fixed.
Yes.
Accrual fixed.
Taking fixed income yield. And how do we manage this? We also manage the maturity, so it's properly gapped.
May benefits naman talaga itong bond fund mo. I mean, in terms of if an investor gets into let's say ALFM bond fund, yung yield mo, for example, you get 6%, 6% ang kinikita niya. Ano bang ngayon ng bumagsak, tumaas interest rates? Are you riding that yield now? Is that how it works?
Well, when rates came out, of course, in the early part of the year, we were still hit because we still had a good chunk of mark-to-market portfolio. Okay. We've adjusted our weights right now, and we are riding the yield, like we participated even in the 10-year 7-quarter bond, participate there, and we're accruing it. So we're riding the repricing rate and slowly increasing our accruals because of it.
Okay, good. Sige. Rico, ang dami natin tanong eh. Can I bring in Mike also? Sabay na kayo ah. So for OFW, should we keep US dollar on hand or send it and save in Philippine bank? What is it? Jonah, take this.
Actually, sagot ko na yan. I've been typing in some answers in the Q&A.
Okay. Sige, sir.
At this time, when the outlook is for more depreciation, it's best. It's a good idea to just preserve your dollars and exchange only what you really need for current expenses, because clearly, talagang magde-depreciate pa eh.
Saan ba pupunta yan, sir? Matanong ko na kayo.
That's a very hazardous thing for any analyst, an economist or analyst to do. Kasi
it becomes an immediate target.
Yep. Nobody gets that. But pero sa direction, sir, looks like
because for as long as we are going to be behind the rate increases of the Fed. No?
Yeah.
Clearly, there's a pressure for depreciation.
Correct.
But yun na nga, tinitimpla ng BSP, they have to really balance it between the considerations for not stifling growth in the economy or even causing a recession, or leading to the depreciation of the peso, and of course, along with that, inflation management. In the end, inflation management pa rin ang top priority because that's the mandate of the Bangko Sentral, to manage inflation. Okay. However, hindi nila pwedeng kalimutan nga yung keeping the economy growing or stable.
Sige. But mabalik din ako dun sa marami tayong advanced questions na pinadala ng mga listeners now, or viewers now. So we asked them advanced questions. So maybe we can take them up one at a time kasi we group them together in categories so that it's simpler. We can take them up one by one, and I pointed to the person who can probably answer this. No, so guys, ladies, can we just flash the advance? So ito, investment strategies. What strategies, tanong ni Arnold, what strategies do we need to weather the storm? Mike, nasagot mo to, no?
Yeah. Well, I think there are a lot of ways for you to be able to weather the storm as an investor. I think number one is you need to be diversified in your portfolio. Don't stick to just one asset class. And I'm not talking about just peso. You also need to have some offshore investments. And I think right now, COL Financial offers a lot of options on dollar-denominated funds, including some of the Sun Life funds that can participate in global equities or global bonds. I think a good mix of a diversified portfolio will definitely shield you from the volatilities in the market and gives you a lot of opportunities as well.
And get a buffer of your money market, di ba? Parang, di ba? Balance. Tama. Great. From Grace, considering all the factors affecting market, is it a good time to pull out our investment? Oh, Rico.
No. It's already, a lot of the pain has already been felt. And yes, in as much as we are going to feel more pain, I think the solution here would be you have COL, which allows you to participate in investments in small chunks. So you're participating slowly and you're diversifying your portfolio slowly so that you even out your portfolio. Because if you get out right now, it's going to be very hard to come right back in. It's going to be very painful for you, and it's also going to be it will be a matter of timing to come back in, and whether you will get that correctly is very hard to do.
Yeah, medyo naipit. But I guess maybe too late to sell now, no? Maybe too late to sell na rin.
Yeah,
no?
Marvin, if I can add on to that, and I think you have the best platform for investors to do it in trickles, right? You cannot. It's hard to time the market, even us professional fund managers. It's like have your crystal ball. So you do it in a form that can be a regular savings plan, right? To invest in staggered basis. And at the same time, Marvin, this is a very good question because when we've seen the history of behavior of clients. On a rising market, you'd see more participation of the retail. But on a downward market, nobody wants to invest. It should be the other way around to make money.
Ngayon na nga, mas mura na nga, ayaw mo pa, di ba?
Yeah, they tend to chase when asset prices are moving higher.
Yeah, that's right. So, peso, I think averaging, yun yung sinasabi ni Rico, no?
Peso-Cost Averaging.
Konti, di ba? Maliliit naman po. You can put it in regular amounts, in small amounts. Okay, next group. Sige, bilisan natin para investment picks. What mutual funds are best to invest in during a declining market? From Hannah. Rico.
Well, I've answered the part of it. Outside funds that have accrual, which will protect you. You also want to maybe look at funds that give you regular dividends, because then when you look at funds that give you regular dividends, and it will be easier for you as an investor to ride out the storm as well, because at least you're still feeling returns. Also, the REIT funds are also very interesting. If you actually look at the relationship of REITs, they're also have a very local relation to. They are actually a defensive fund versus inflation, which Mr. Salceda already claimed to be 8%. So we need protection from that.
So dividend paying funds and yung accrual base. Good. Now ask Nices, what are the least risky type of investment? Well, Mike,
money market is the least like time deposit, right? Higher than time deposits.
Yeah. Paano ba yun? How were you able to earn more than time deposit? Yung money, you have the largest money market in the industry. Paano nagagawa yun?
Well, again, it's a mix of being able to invest in other fixed income instruments at the same time having a certain accrual portion to minimize any fluctuations and the NAV. So unlike money market, unlike a time deposit where it's just a fixed rate, for us, we're able to go and invest in slightly longer and higher yielding instruments, which gives you the kicker.
So meron kang mix na long tsaka short.
But ang average duration mo dapat it's just a year or so.
But you can take it out anytime rin. Maganda yung yield.
Yeah.
And time deposit, tali ka. 30 days, tali ka doon.
30 days, yun. Ito, I think for 7 days lang kami and then very liquid na after 7 days holding period.
Ano mga yield niyan?
Well, right now, I think we're running at about 1.5% on an annualized basis net.
Net? Oh,
yeah.
Anong gross nun? Mga more than 2.
Divided by 0.8. Oh.
On a short term?
1.875. Close to 2.
Close to 2. Okay, galing. Sige, next. Next group, bond funds na naman, no? From Roji. Where are corporate and government bond rates headed? Any forecast on the rates for the next 3 to 5 years? Gentlemen, sinong gustong manyan? Rico?
I can take it. But definitely rates are going up still because of, again, we still have to react to policy rates. But Mike has gladly mentioned that the long end has actually gone ahead of it already, where long ends have gone significantly higher. So in as much as we still believe that rates across the curve will go up further, the curve might flatten. When I say the curve might flatten, you probably will see shorter term rates react more to policy rate increases rather than the long end.
Yeah.
Yung flat nun, para bang curve yun? Yung long end, mataas, yung short end, mababa. Yung sinasabi yung flat, gaganyan, tataas yung short. Is that what you... Yeah.
Tataas yung short.
Good. Mike, ito naman isa, si Jasmine. Should we transfer our equity funds to bond funds now? Ako medyo...
I think no.
Okay.
We should buy more equity funds and don't invest because as we mentioned, bond funds can still be hit by mark-to-market as rates, although we've been adjusting the duration, or meaning we're shortening or investing in shorter dated bonds, tatamaan ka pa rin eh. As opposed to equities, well, it's probably going back. Baka depending on the risk profile. Kung baka hindi niya na kaya yung volatility na equities, then probably a bond fund would be less volatile. But if you can handle the volatility of equity funds, I think now is a perfect time to invest in equities.
So balance lang, if you cannot take kung di ka makatulog dahil sa volatility.
Yeah, get out of that asset class. It's not for you.
It's not for you. No? Kung pang bond fund ka, medyo stable naman. Konting galaw, but less volatile than equities. Sige, let's get the other group of questions. Ito, Peso-Cost Averaging. Sinabi niyo na rin to, no? Is Peso-Cost Averaging strategy effective at this moment? From Ronald. Yeah.
I believe so.
Answer dito rin.
Mike, ito na yan eh. What does that mean? So, pag bumaba ang price, that's you buy, continuous buying, so nag-average siya. Is that basically?
Yeah, you can take advantage of a lower level in the market. And at the same time, when it adjusts higher, at least you can average up and average down. So you get an average price rather than just invest one time and hope that that is the perfect time.
Yeah. Mahirap yung buy and hold lang, you know? I mean, I guess buy slowly, buy in small chunks and do it regularly. I think that's the key. Hindi naman natin mapipredict yan eh. Diba?
Yeah, and we have to hide. Go ahead.
Rico.
Yeah, and you have the perfect platform to do that, Marvin.
Yeah. Thank you for that. Sige. Oh, let's get the other questions. Rising rates and inflation. Tanong ni Beth, how can the Philippines adapt to rising rates and recession in the foreseeable future? Baka si Doc is still here, is Doc Habito. How can the Philippines adapt to rising rates and recession in the foreseeable future? Sir.
Well, talagang ano nga, the inevitability of these rising rates. Well, recession is something that can be avoided precisely. That's why the Bangko Sentral is being very careful. Pero yung rising rates, including inflation, can best be done the way we have done in the past. No, we really have to really, of course, manage our expenditures so that we can avoid having to be too dependent on the things that are most rapid in their price increases. Unfortunately, the reality is nga, food ang talagang mataas ngayon, the basic necessities. But again, there's a way to manage that at the household level. During the pandemic, marami sa ating nag-home gardening na and that really became a very good coping mechanism. And seriously, that is a very useful way to mitigate the impacts of the higher cost of food in the market.
Yeah. Yeah. Yes, sir.
No, just as I said, talagang ano yun tama yung word na adapt. We simply have to adapt to it and do the kind of solutions that are accessible to us at the household level to be able to cope with more difficult times.
Okay. Thank you. I think we have one more in the group questions. REITs. Sinabi mo to kanina, Rico. Should we continue to invest in REITs? Baka yung dividend tamaan.
Oh, well, the strategy, especially local REITs, a lot of the local REITs, the dividend policy is to give almost all the dividends. You have their lease tenors are quite long, and if you were making 5% only 6 months back, you're now making 7%, given current prices, right? So especially given a lot of the names in the REIT market are good names, you concentrate on the quality names. I think it's still a good defensive asset to be in.
Yeah. Ano naman to mga office REITs, di ba? Pag office REITs, they have this long...
their lease is close 3 to 5 years, so you're not really gonna get hit.
Yeah, saka mga BPO yan no? This is mga BPO. But
depending on the names.
Yeah, will they be affected by high interest rates? Itong mga lease payments sa mga nagre-rent sa office spaces.
What do you mean?
Kung tumaas ang interest rates, will the REIT company be affected in terms of its payout to the investors?
No, because they're already locked in with their contracts.
Yeah, and I think none are levered. I mean, none of the REIT companies have debt. I think that asset transfer is all in cash. So I think REITs would be a good alternative for those who like or who would want regular income. And exposure to the real estate market is something that we can do.
Yeah. Tsaka nakadikit yata yan. Pag umataas ang inflation, tumataas din yata ang rental rates. Ano? O parang meron silang automatic adjustment para bang inflation.
For some, yes. Yeah, but for some naman have long-term locked-in rates and then it's repriceable every so often.
So tanong na yung Celica, Mike, are REITs safer to invest than bonds?
Different asset classes. Well, again, a bond can be subjected to a default, but unless it's a government bond, REIT can give you the same yield and a price appreciation as well. And it's a real estate play or an office play as opposed to a credit play.
Depende sa bond, ano, kung bond is like medyo high risk bond, medyo, 'di ba? It's parang ganun titingnan yan, no?
Yeah. Especially office, I think office can be a bit resilient as opposed to a pure real estate development, which is cyclical, right?
Right. So itong mga BPOs, sir, Doc Habito, how do you think about these mga BPOs? Are we going to be affected, or mukhang we're going to benefit pa rin because of exchange rate? Ano?
Kasi nga ang BPO, the countries abroad who are outsourcing to us find it even cheaper to source to us. The harder things get over in their own home ground. Kasi nga, especially with the peso that is getting depreciated, nagiging mas mura para sa kanila to even do the business here. So in that sense, medyo yung BPOs medyo protectado even in that sense.
And the jobs that we're looking at, baka doon talaga tayo mag-concentrate, sir.
Yeah. I mean, the incomes in the export sectors in general are helped. This is the reason why I don't feel as afraid of peso depreciation as others normally would be. Kasi nga, matutulungan niya. Frankly, it helps not only export-oriented industries, whether services like BPOs or exporters of commodities. It also helps domestically oriented firms because the peso cost of imported competitors becomes higher with a higher exchange rate. So both domestically oriented and export-oriented producers and enterprises are favored by a higher exchange rate. That's why, again, that's the reason why I don't want to call it a weaker peso. We become a more competitive economy with a depreciated peso.
Teka muna, sir. Let me just try to clarify that. So if you're a local producer and you're importing your raw material,
I'm talking about if you're a local producer, and hopefully not too dependent on imported inputs, but if you're a local producer, the price of your competing imports becomes higher.
Okay. So you're parang getting your raw materials here, lalabanan mo yung mga ibang nag-i-import.
Yeah, but of course, if you're highly import dependent on the inputs, then it doesn't help you that much. But a local producer, domestically oriented, lalo na agriculture, kasi an exchange rate depreciation is like you suddenly put a higher tariff rate on all imports uniformly. So talagang biglang naging mahal ang imports. So your competitor imports are now at a disadvantage compared to you. Yun ang
okay. If, like for example, let me just go through that further. For example, rice. Ikaw rice farmer ka. Compare mo yung imported rice. You're saying because of the exchange rate, mas mahal ngayon yung import mong rice.
Magiging mahal yung imported rice. Yes.
Rice. Better na. Okay. All right. Sige. We have some more gentlemen na baka few minutes muna tayo. We'll have more live questions pa if beg your indulgence. Let's get some of them. Ito yung mga gusto nila napapakinggan . From Hero, at what percentage of debt to GDP ratio you would consider alarming if the GDP falls below 5%, and with the excessive debt and depreciating peso, are we at risk to pay our foreign debt? Sir.
I actually just typed in the reply to that. But kasi nga, ang considered threshold is 60%. And in fact, we had actually gone down from about 75 in the first decade, 2000s, to 39 just before the pandemic. Yun nga lang, because of the COVID expenditure that we have again gone up to 60 and now slightly above 60. So ano na nga tayo well, I wouldn't say alarming, but medyo yan na yung threshold. But we had been at 75 before. But of course, that was the time we had that crisis that led us to increase the VAT from 10 to 12%. Yun it was about 2006, 2007, when our debt to GDP ratio was about 75%. It was necessary for us to really raise taxes. Now, hopefully this time around, raising the VAT will not be one of those options to be considered. And if the GDP growth falls below 5%, it will be, frankly, the reason why debt is not necessarily bad is that you can use debt to grow the economy. So that's why if whatever additional debt that we may incur and may have to incur would best be to actually induce more growth. So that would mean better infrastructure, and whatever else that can actually immediately lead to higher GDP growth. Because we've been hearing our financial managers say, the important thing is for us to be able to grow out of the debt. In other words, if the growth, the simplest way to put it is this: if our economy grows faster than our debt grows, then we are actually able to grow out of the debt. See, we are able to pay the debt faster than the debt is accumulating.
They're concentrating on the growth. Si Jokno is concentrating on the growth. Yeah, right. Next question, please. Let's get some more questions from Riza. Where does one newbie investor start given the market conditions? Rico, how do they start?
Okay, it's actually a nice question, although we probably will need more risk appetite questions here. But that being said, if you're a newbie, and I will just assume that your risk appetite is not that strong, so I think you start off with the more conservative assets. So for now, I suggest you stay away from equities. And you can probably range from the money market, which is the most conservative, to bonds in general. But stay away from equities first, as you're the newbie and the market conditions will probably scare you a lot. But it will take more risk questions to find out really what the proper answer. But I think that's
pero kung newbie siya, ito, Rico, newbie, young newbie, or like have more years ahead of you, starting invest pa lang, di ba? Isn't it
honestly, if you're young and you're really looking for investment, if we trust the government, as Mr. Habito is saying, we're still growing by 5 to 6%, which is normal for us. But that's actually quite high for the world. Outside South Asia, that's quite high. And corporate earnings will still grow anywhere from 18 to 21% as long as we can maintain it. The problem is it's a risk-off environment. But if you just look at the numbers, our numbers are still pretty good. And the stock market, as Mike also mentioned, is actually looking pretty well, because if you're looking at corporate earnings growth from 18 to 21% for next year, that still promotes very good growth for us. So again, the risk appetite really is important. The long-term future of the stock market is looking nice, especially because of where we are now. But again, you have to believe in certain conditions. If you believe in the growth story of the Philippines, we believe in our prospects, then yeah.
Yeah, right. So pagbata, pwede pa. But wait, gentlemen, but tomorrow our session will be on the stock market also. So medyo you can also ask questions there tomorrow with some of our other fund managers who are managing equities as well. Sige, let's get another question, please. How to take advantage of higher interest rates? Is there an advantage in increasing inflation rate? From John M. Mike?
Well, again, as interest rates would react to higher inflation. Well, because it's one way to combat inflation is to adjust interest rates. So how do you take advantage? If you're a new investor, try investing in accrual funds, such as what Rico mentioned, which gives you a good yield on an annual basis. So that will definitely add on without exposing yourself to too much risk. And I think this is as I mentioned, we haven't seen these levels of interest rates over the last few years. So take advantage.
Yeah. What about the REITs then? No? Pagka may higher yield in REITs.
Yeah, because the original yield of REITs was based on the launch price. But if the price of the REIT goes down, effectively the yield would be much higher, because the dividend yield will not change. Yeah. I mean, the rate of dividends that they will pay out will not change.
Yeah, even going to grow higher. So next. From Diona, I turned 40 years old this year and started investing heavily in stocks also this year. I did not see this coming. Did I make a wrong move? Should I put my investments on hold? At what age should I stop investing in equity? Rico.
Well, ma'am, at 40 years old, you're still much younger than I am. And I still believe in the stock market. Another person who actually still believes in the stock market, much older than us, is Warren Buffett, right?
Okay.
So, unfortunately, in hindsight, then you can say, yes, we were wrong investing last year or early part of this year. But the stock market is a mechanism where it really promotes long-term growth. Of course, there will be external shocks, and those shocks are the ones that are quite painful when it happens. Unfortunately, it's happening now. As to age requirement when to stop investing in equities, I really don't see an age limit. It really depends on, like, for some people, investing in the stock market is also a way of passing on generational wealth, because whatever your investments now may eventually go to your kids or to your family members. So I'm not giving up on the stock market, although it's not nice year to date, down 14%. But I wouldn't say it's a totally a wrong call. Maybe it's a wrong call year to date.
Should not stop, but you should not stop.
Marvin, maybe I can give a different perspective on this. I assume that this was she invested directly in stocks, and I think during these volatile times, I think you would probably need a combination of direct and probably employing a fund manager to help you navigate through all these turmoil in the financial market, so you can have a combination of investing direct and investing a portion and leave it with a professional through some of the various funds that being offered by COL.
And diversified ka pa. Diversified pa.
Yeah, I guess that's the key word really right now. The best answer to this crisis is diversification.
Yeah. Okay, so let's get a couple more. And then from Lino, do you think the interest rates have already peaked or may itataas pa? How will this affect my bond funds if I buy now? Mike?
I think given where the 10-year yield is and where the recent 7-year auction, meaning when the Bureau of Treasury launched a 7-year, it was rejected. Meaning, I think the government is already starting not to accept the bids of the market. Meaning, I think they're okay at these levels. I think it's too expensive for them to borrow at a much higher rate, given the level of need that they need. I think they've already pre-funded a lot. So, to answer the question, I think if ever, konti na lang, kung meron pa. Pero I think we are approaching the of a 7-year, 10-year.
All right. Sige. Medyo nag-extend na tayo. Medyo last question na lang siguro muna tayo at this point. And I will ask you to say a last few words siguro after answering this. From Grace M, is it better to be risk off ngayon and look at money market fund muna? Or is it time to be more aggressive now that prices are lower? Mike?
Well, I guess it's should be a combination. Build a portfolio. Have some in money market, have some in equities, have some in bond funds. I think you can move your asset allocation as you deem fit depending on the movement of the market. I think what's important right now is you have exposure, both on equities, you have money market to have some short-term money to be able to take advantage of dips in the market.
Great, great. That's our last question na muna at this point, gentlemen. Maraming salamat. Maybe you can say last few, Mike, and then I move to you, Rico, and then last, Dr. Habito.
Okay, I think right now we're for especially the new investors who have just entered the market over the last 5, even 10 years. I think we're so used to low rates, high equities. I think now we are seeing what we call the old normal in interest rates, where interest rates are high and equity returns are much higher. So I think right now gives you an opportunity to lock in higher rates from the last few years. I think higher interest rates are here to stay. And at the same time, normally equity markets would react to the dislocation in interest rates. And I think it's just a normal course in the financial market. So you can take advantage.
Take advantage. Rico?
On our end, I agree. The markets really are now at the point where you should be agile enough to be able to position. And being you guys are in COL, I think you have the right platform in COL that will help you be agile enough to be quick to decide what funds you want to be in. Again, we agree. You should be in. It's all about asset allocation right now, where you think you need your cash more, but you should be in the market.
Thank you for that. Thank you, Mike. Sir, last few for our listeners today.
My own final remarks will not be in terms of the investment behavior of your audience, obviously, because that is the theme of this two-day gathering. But in terms of as general citizens, kasi may mga questions lumabas, no? What can we do as ordinary citizens under these circumstances of increasing difficulties? And I'll just repeat something I heard from a Thai politician in a speech I heard him say many years ago. And I thought there was a lot of wisdom in it, especially if you go beyond the seeming simpleness. Ito lang sinabi niya. At times like this, what we need to do is produce more, consume less, and share more. And that, and with that, produce more means being more productive in what you do, or doing something you haven't done before. That's the kind of thing I think that everybody needs to be thinking right now, because maraming nangangailangan, and that's the last part of it. Share more as well. Thank you, and I guess we all need to keep praying, because there's so much we need to pray about.
Yes, and prayers, of course. You consume less, gusto ko rin yun. Medyo marami nagda-diet na ngayon. Okay, gentlemen, thank you very much for your time. Allow me to close this day to give you a sum of our key takeaways from our discussion today. Very interesting discussions from fund managers and from our economist guest. So, can the Philippines weather the storm? I guess the short answer is yes. But with a big but, as presented today, we face serious challenges in the economy, both global and domestic concerns. On the domestic front, sabi nga ni Dr. Habito, in his presentation, we are experiencing some economic shifts. And the way to move forward are 5 things that he suggested for the new administration to focus on: the people and agriculture. We have a good team or economic team, but the challenges on the fiscal side will make their jobs difficult. So managing our finances and inflation will be key. 4, what to do as an investor for the fixed income, as shared by our fund managers. While rates are going up, it allows the investors to benefit from getting higher yields. Money market funds are now giving us higher than bank deposits, about 1.5 net, allowing us to rebuild our emergency funds. Those who used it up, you can build up your emergency fund through money market and also use it as a parking facility while waiting for opportunities to invest as the markets or the stock market settle down. Bond funds that are accrual-based, yung sinabi ni Rico kanina. Accrual meaning yung medyo stable is also something to consider for better protection in market value declines while it rides as it reprices and it rides on higher yields.